Hi everyone, it's Grace. Welcome back to my channel. So in the last week's video, I actually showed you what's going on in the Texas market in terms of its current housing price, its year-over-year change, and some of the other factors such as the inventory change and price cut change. So those are the things that are really important to discuss as we see the mortgage rate going up like really fast in the first quarter of this year. So today, well, you can see that the webcam and also like the setting is a little bit different because I want to show you a screen share, and so I'm using the webcam on my computer. So I hope you can get used to this. So let's just get started. You know, I post on my community channel quite a lot, you know, whether it's the chart that I did earlier or polls or things like that. So today we're going to discuss like two very, very important charts. The first one is the for sale inventory, so literally like the inventory that's available that you can find it online on Zillow, and this data is also from Zillow from March to 2021 to 22. And then we're also going to look at the typical home price. So these two charts are super important, but before we jump into that, I just want to show you the polls that I did earlier. I think it's very important to understand the market sentiment in terms of what buyers and sellers think at this particular point in time. So the first question is that under which of these following conditions will you buy a property? And the first one is a dip up. The second one is a near peak. The third one is a crash, and the fourth one is bottom out. And the last one, I also designed a question asking, you know, just saying, you know, I'm not buying regardless what happens to the market. So you can see that buyers are like very, very steered to either like buying during a crash or bottom out. So like 80% of people say that, you know, they will buy when there's a crash coming in, either in the middle of it or bottom out. So there's like only 9% saying that they will buy a dip up. So you can clearly see that the mortgage rate hike, in fact, is kicking in, especially for buyers, for the obvious reason that a lot of people just don't want to take a lot of loans at this particular point in time, right? I mean, that's really understandable. And then when we take a look at the seller side, well, all the five choices are still the same, but it's totally different. It's kind of the opposite. So only about a quarter of the people say that they will sell near peak, which in my understanding is that you want to cash out the equity that you have built since the pandemic. So that's why you sell. However, there are a third of the people say that they will not sell regardless of how the market behaves. And that tells me either they're living as a primary residence or they're seeking like a long-term equity or a super equity multiplier that they're just not willing to sell, whether this market crashes in the post-2022 crash or not, you know, not interested. And another 36% said that they will sell either during a crash or a bottom out. So I'm guessing that, you know, people sell not because they are motivated to sell, because they're forced to sell. They don't want to, but they kind of have to, either to keep liquidity or use the money for something else. So you can see that right now buyers and sellers are kind of in a standoff. And because this poll, the number is a little bit low, so I'm going to supplement it with another poll that I did earlier, asking would you sell a property that decreases in value? So in this poll, you can clearly see that like 80% of the people say that, you know, they will not sell. So that's actually higher than those who say they will sell during a value decrease. So I'm guessing you don't want to sell, because if you're selling when the property decreases in value, then you're losing money, right? So this is how I understand the market sentiment during polls. So just keep this in mind, because when we discuss the data charts, we're going to go back to the polls and look at them together. All right. So in the next part, let's just take a look at these two maps side by side. You know, I do a lot of like these comparisons, and I just think that it's important to have a comprehensive understanding instead of like saying, oh, these numbers or these colors are indicating something really odd and it's like happening right away, but I don't want to do that. Let's do it in a very quantitative and scientific way. So, in the first map, I'm going to explain the legend for a little bit first. So in the first map that you're seeing is the for sale inventory from March 2021 to 22 in the metro areas in the US. Okay, so the inventory change is year over year because I want to rule out the up and down patterns in seasonal, right? Because in the last video, obviously you saw there's a pattern in the Texas market, and so that's just one thing that you should keep in mind. So if it's a negative percentage, it means that the inventory is decreasing. So there's just not a lot of inventory coming onto the market, and that's a negative number, and it's marked by blue. And then if the inventory is picking up, then it's brown and it's positive. So that means the inventory is picking up quite a lot. So in this map, you can see that, one thing I get people saying a lot is that, the Sun Belt states are so hot. They're like the hottest real estate markets and people are rushing into these areas, but that's not necessarily the case. You have to look at the specific location. And as you can see on the map, the brown areas or yellow areas are quite scattered. So that's why you need to look at the specific areas when you look at this map. All right, so I'm just going to jump into this comparison map a little bit, and then let's start with Texas. And by the way, if you are interested in the Texas market that I did last week, make sure to check out on the top corner here. Let's go to Brenham, Texas, and you're seeing that the inventory is increasing by 126%. So that's like crazy, even though the inventory number itself is not that high. And then when we compare with the year over year change, we can see that, the price is still increasing by 15%. So that's a little bit odd. And when we are analyzing this kind of situation, I also think that it's important to go to the market and see what's going on. So let's just type in. All right, so we're now in Brenham, and then let's go ahead and take a look at the listings, just quickly browse through what's going on. And immediately you can see that there are price cuts coming in. The price cut increments are different depending on the area, but you can see a lot of heavy price cuts just kicking in very quickly. For example, like for this one, obviously it's a luxury market, but its price cut is nearly like 40%. So you know for a fact that this particular property is crashing because the year-over-year change is 15%. So if you minus by 40%, that means it's crashing by 25%, right? But that's just the one property. Let's go ahead and scroll over to the other properties, and then you can see like these properties, and then you can see like these properties are like cutting by 10,000, 10,000, 19,000. Yeah, so you can clearly see that there is a pattern there. So in the next part, I'm going to show you how you can quantify the timeline and the increment of the crash. Because this video, we're going to only focus on the markets, the housing markets that are starting to crash. They're not crashing right away, but they're showing signs, I would say, very similar to the bonds market. I'm a numbers person. I like crunching numbers, and I never arrive at any conclusion without calculating first. All right, so let's use this property as an example, and I'm going to show you how you can quantify the housing crash timeline and increment. So the first thing that you have to do is figure out the percentage of the price cut versus the market value. So for this property, for instance, the price cut is $3,400, divided by 415K. So that gives you about 8% price cut, right? So that does not mean that it's crashing by 8% right now. It just means that there's a price cut. So the next step, we're going to go to the same market. All right, so this tells you the price is still increasing by 15% year over year. So you're going to have to incorporate this number into the next step. So what do? You have to subtract 8% from 15%. So that's minus 8%, and that gives you 7%. So what does that mean? That means for this property alone, from this March to next March, its price growth is going to be 7% instead of maintaining at the same level at 15% because of the price cut. So this is what's going to how it's going to react in the year to come. And then if assume that everything stays the same, and then we're going to continue the same price cut, and then it's going to be negative 1%. That means from 23 to 24, it's going to crash by 1%. And then if we continue this pattern, it's going to be negative 9%. So from 24 to 25, it's going to crash by 9%. So that's how you figure out when it's going to crash, how much it's going to crash. However, here's an important point. Because we know that the mortgage rate is increasing, right? Because the Fed funds rate is increasing. So, this price cut percentage is going to be greater. That means the housing crash is going to come forward probably in 2 years, 1.5, or even 1 year if the mortgage rate hike goes more aggressive. So this is how you need to pay attention to the Fed funds rate schedule and what is going on in the market. But I can also tell you this. In this market alone, the buyers are very, very dependent on low mortgage rate and affordable monthly payments. Because without these two things, they're not going to be able to stay in this market. That's why the buyers are standing by right now. And it also explains why 40% are waiting for a crash, and another 40% are waiting for a bottom out. So it matches the market sentiment. I'm mentioning a couple of other areas in Texas. So the next area that also has a pretty deep inventory increase is Vernon in Texas as well, and it's increasing by 83%. And then its year-over-year price growth is also at 15%. So you know that this market is also very reactive because of the mortgage rate increase and unaffordability of the monthly payments from buyers. And they're just standing by. And I can also feel that property owners in these areas are kind of getting desperate to get rid of the properties because of the mortgage rate hike. And then other areas like Jacksonville, Texas, not Jacksonville in Florida, that's a whole different story. And its year-over-year change of the inventory is also picking up by 44%. So that market is also getting a little bit dangerous. It's acting more like the bonds market, where the bonds market is very reactive to the treasury yield increase, and then these housing markets are very sensitive to the mortgage, especially the fixed 30-year fixed mortgage rate. So the next one is Snyder, and its year-over-year increase in price is also at 15%. So just pay attention to these very dark brown areas where inventories are picking up as soon as the mortgage rate is hiking. And we're not even talking about the Fed funds rate hitting up to the top. So I'm going to show you what that means. I do a lot of graphics and stuff like that and charts, so that's how I visualize the macro policy, and I think it's really important to share with you. All right, so if we scroll down here, this is a motion chart that I share with you a lot when I talk about it in my channel. I think that the majority of the housing market is still booming, if you will, and they follow the progress of the Fed funds rate. So in this chart, the blue line is the Fed funds rate, and the red bar is the foreclosure rate. So basically, the red bar shows you when is the peak of the housing crash. So it's at this point, right? And this is in 2008. So the majority of the housing market actually follows this pattern. And where are we right now? We're at the very early stage, probably right here, right? It's just started hiking. And then I'm going to go to the Federal Reserve Bank of New York just to show you what is the effective Fed funds rate. Like, as of yesterday, is at 0.33%. So it just started hiking. It's not even like at this point yet. However, you're seeing like these markets are reacting. They're having like sort of like a allergic reaction to it. So you need to pay very, very close attention to those markets. All right. And then what I'm also going to do is I want to compare a market that's not reacting at all, or that's not like acting as crazy. For example, like in Houston, its year-over-year change in inventory is decreasing by 28%. So it's not reacting to the mortgage rate hike. And then in Austin, it's decreasing by 12%. San Antonio is decreasing by 30%. So that's like acting the exact opposite. And then Dallas and Fort Worth is decreasing by 25%. And these areas are still increasing in the year-over-year change in price. So that's a totally different story, and don't expect those housing markets to act like the bonds market. So that's what you need to pay very close attention to, these subtle micro market movement. And then let's go to the West Coast to take a look at the situation for a little bit, because you can clearly see that the inventory is picking up like really fast in some of the areas. But then if you compare to the right map here where it shows the year-over-year change in prices, they're all going up. So you know that, by comparing these maps, you know that for some of the real estate markets, some places are really overvalued, and there's not a lot of like inflexible demand from renters and would-be buyers to support it. So that's dangerous. And for example, these two markets that are reacting exactly like the bonds market, as soon as the cost of mortgage is picking up, its inventory is hitting the market. The sellers are just getting kind of like, I want out. I don't want to hold anymore. Whoever buys this, I just don't want to hold the properties in these markets anymore. That's what it's saying. So we're looking at Pocatello, where its inventory is picking up by 71%. And at the same time, I also want you to look at the year-over-year growth in price at 29%. So that tells you it's overvalued and its bubble is bursting right now. There's not enough renters and buyers interested in these areas. So that's why they're acting this way. All right. So let's just keep in mind that in Pocatello, its year-over-year growth is at 29%. So let's go to the Zelle website. All right, so now we're at Pocatello. So let's take a look at what's going on in the market. And then you see like great price cut, 30K, 79K, 6K, 50K. So you're seeing a lot of inventories hitting the market, and then price cuts are coming in as well. So you kind of get like, okay, this area is showing very, very early signs of crashing, and it's starting. The process has already begun, and then as the mortgage rate continues to go higher, like 6% or even more, I don't know how much it's going to hit but by the end of the year, it's going to look, the mortgage rate is going to probably be beyond 6 or 7% if the mortgage rate continues to go up and up. So this market is going to crash down. So let's do the same thing. I'm going to use the calculator to show you when it's going to crash and how much it's going to crash. For example, let's take this one. Like, let's take another example where the price cut is a little bit aggressive. All right, so the price cut for this one is 120,000. So I don't know what's going on, but it's cutting price like crazy. So it's a 12% price cut. So that's like really overvalued. And it's like really mind-blowing. Okay, so this one is 12%. And then when we go to Pocatello, it's at 29% year-over-year increase. So it tells you that from this March to next March, the price increase is gonna decrease to 17%. And then we continue the price cut pattern, it's gonna be 5%. Continue once again, it's going to be 7% crash. So in 3 years, the majority of this market, the properties in this market is going to crash by 7%. It's going to go down probably like a landslide, if you will. By the way, I also want to show you the chart of the foreclosure rate in terms of the Fed funds rate. Let's just look at the Idaho market for a little bit. So the way you actually magnify these little things is that you highlight the part that you want to see only, and then you right click it, and then there's keep only, and then you can see a magnified graphic of this chart here. So at the beginning of the rate hike is at 2004. So the foreclosure rate is actually very low, and it continues to go lower when the Fed funds rate hits like 5%, 5.26% or something like that in 2006. So that tells you the housing market doesn't necessarily have to have like a super high foreclosure rate in order to crash. Some of the properties are already showing early signs of crashing, possibly because, you know, owners of these properties, they invest some money in there and they're not seeing the equity picking up, so they want out. They want to cash out the equity, and, you know, possibly use the money for something else. So that's why it's acting this way. However, the other thing I want to mention is that this is in 2008, so the Fed funds rate is increased to 5%. So that's like beyond neutral zone, and the Fed is talking about like getting to 2% or 2.5% by the end of the year, to the neutral, that's called a neutral zone, as soon as possible. But the thing is that I don't know whether it's going to stay there for a few years or go up to 5% like in 2008. So we're going to have to look at those two numbers in the middle of the year and by the end of the year to see, you know, what is the Fed thinking. So now let's go to the West Coast, to Washington State for a little bit. And you can see that some of these housing markets, the inventory is picking up really fast for the year-over-year change. For example, in Othello, it's increasing by 55%, even though it's also, the inventory count is not that high. And then in Aberdeen, it's 44%. In Port Angeles, it's 28%. So these areas you need to pay very close attention to. All right, so when we look at the year-over-year change, in Aberdeen is at 32%, in Port Angeles is at 35%, so these markets are speculative. There are just not enough renters and would-be buyers to sustain the inflexible demand. So in previous videos, I talked about the definition of inflexible demand. People don't really react to the market highs and lows. They have their own thought, sort of like. So whether the market goes up or down, they're just not very reactive to it. But you kind of need the inflexible demand in order for a real estate market to be crash resistant, if that makes sense. All right, so let's do this. For the Aberdeen market, let's do the same calculation as we did before to figure out when is the crash coming and how much is coming. All right, so let's just remember that the Aberdeen market, it's increasing by 32%. And then we're definitely going to come back here to look at that number. So right now we're in Aberdeen. And then let's take a look at the properties. Just glance through what's going on. You can see a lot of inventories are hitting the market. That's the first thing that you're going to notice. And then the second thing is that there's going to be price cuts here and there. For example, this one is 5,000, price cut 25,000, so that's kind of hefty. Right, so let's take this property as an example to do the same calculation, but this time we're going to do a little bit different tweak on it. So the first thing is to figure out the percentage of the price cut and the market value, right? So 25,000 divided by 300K, then you have 7% price cut. All right, so let's go back to Aberdeen, Washington, and you can see that the year-over-year change is at 32%. All right, so this time we're going to do a little bit different thing. We're going to divide 32% by 7% price cut. Why is this number important? That tells you in 4.5 years, the price growth is going to be 0%. That means the price is reaching the absolute peak and it's crashing down. So obviously in this market, the year-over-year growth in prices is too high. It's like 32%, but it's speculative. So it's going to take a while for it to go down to the crash point. So this is a quick way to find out when the crash is happening. But then again, the mortgage rate is increasing very fast. So we're definitely not going to see 4.5 years, possibly earlier than that, right? So this is another way to find out what's going on. So let's go to the Oregon real estate market to see what's going on. You can also see that there are some markets, the inventory are picking up like really, really fast. In Grants Pass, it increased by 42%. So that's not normal. And if we compare the year-over-year change in price, it's only increasing by 19%. So just by comparing that number, we can tell that, you know, it's not as overvalued as a place like Aberdeen. So when we calculate the housing crash, we can see that it's not going to crash in 4.5 years. It's probably going to come sooner just because the increase in price is not that high. So you got to figure out, you know, if you want to know when exactly the housing crash is coming, you have to do the calculation, guys. That's super important. And then when we look at the California markets, it's also a little bit different. Obviously, this is one of the states that are like super, super overvalued, but we also see a lot of migration out of the states to other states, right? So the inventory change here tells me that there are not enough renters or buyers that are interested in this area anymore. Not as interested as before the pandemic. I think that, you know, the pandemic changed a lot of things. People just don't want to live. They get paid a lot, but the living expenses is just unbearable. They want out. So you can tell that it's happening in these areas. For example, in Ukiah, you can see that the inventory is picking up by 31%. In Clearlake, it's picking up by 30%. So these two areas are also reactive. And they're starting. And some of you asked, like, what's happening in, you know, the central California areas. We can see the pattern is a little bit different. In some areas, it's picking up. In other areas, it's decreasing a little bit. But the inventory pattern is also, like, creeping up a little bit. So that's the other thing that you should know. It's not having a major allergic reaction to mortgage rate hike, but it's also picking up. So let's go to Merced and take a look at what's going on in the market in Zelle in a little bit. So just to pay attention that the year-over-year change of inventory is 6%, so that's not like super crazy. The year over year price increases at 26%, so that's also a little bit overvalued. In Merced, let's just go through the properties to see what's going on. We can see this one is 10K price cut. This one is close to 10K. Not a lot of price cut in this market as of now. And this one is $8,000 price cut. So we're not seeing, you know, a lot of like price cut in this market. But let's just use this property as an example to do the same calculation. All right. So it's 8,000 price cut divided by 322K, and that gives you approximately 2.5% price cut. Let's just go with 2.5%. All right. So in Merced, we're seeing that the year-over-year change in price is 26%. So that's going to take a while. All right. So 0.26 divided by 0.025. So that's the price increase divided by the price cut percentage. So that's going to take 10 years. I mean, just by like calculation here, you can kind of get an idea that it's not going to have an immediate crash or midterm crash, to be honest, because I don't see a lot of like crazy movement in this market. What does that tell you? That tells you that this market is still pretty hot, and a lot of people are rushing into this area, probably because it's a little bit more affordable than the other parts of California. And then if it's not reacting to the mortgage rate, then we're going to have to see higher Fed funds rate, and then obviously the economy has to be totally different in order for this market to have a major crash, but we don't know when that's going to happen. So I do think that it's important to go into these markets, right? Guys, so click into these markets, look at their year-over-year change in inventory and their price change, and then go on Zillow, put in the area that you're looking for, and then do your calculation and figure out what's going on in the market. So you need to have total control of the situation in order to, you know, have a better position, whether you want to buy or sell or whatever you want to do in this market. In Nevada, we can see the pattern is very uneven. In Las Vegas, its inventory is dropping a little bit by 13%, and its year-over-year price change is at 32%. So there are still a lot of people coming into this area buying like crazy. So we're not going to see a lot of movement in this area. So that area is definitely not crashing right now, and it's not even like crashing in a few years. All right, so the other areas that are starting to crash, like Winnemucca at 42%, and then Pahrump at 24%. So these two areas, and then in Vernon it's at 2%. So just start with these areas instead of the areas that are marked by blue. If we go down to New Mexico, we can also see that there's quite a bit of inventory pickup in Gallup by 57%. So guys, just start with these really brown areas and focus on that, because that's when you're going to be able to see the crash is starting right now as we speak. So now let's go over to the Midwest and eastern part of the states. You can actually see that these two maps are starting to become a little bit different. In the price year-over-year change, a lot of these real estate markets, you can see that they're still going up. However, if you're looking at the inventory change, you know, some markets are starting to pick up. More listings are coming to the markets. So just for today, we're only going to focus on the markets that are starting to crash and not, just forget about the markets that are still going up like crazy. We're going to reserve that for the next video because clearly they are displaying different patterns. So let's go over to Iowa. Let's see this dot here. This one is Spencer, and its inventory is picking up by 79%. And then let's take a look at the price increase. It's only picking up by 7%. That's a very interesting thing because the CPI just went up to 8.5%. So that means this market is not even picking up to inflation. So I think that this market is decreasing in value if you factor in CPI. So let's go over to Zelle website to take a look at what's going on in this market. You can see that the price in general is not really high. A few places are a little bit overvalued, and for this one the price cut is at close to 20K. And some of these properties are on Zelle like for a really long time. So I think that in like markets like this, it's really underperforming. During the pandemic, they're not even like picking up that much because supposedly when the Fed increases its balance sheet, the housing market is supposed to be like boom, right? It's supposed to act like that, but there are some markets that are like seriously underperforming. So in these areas, you're also going to see the inventory is like fluctuating according to the mortgage rate quite a bit. And then when the price is crashing down, obviously their market value are not that high. So the volatility is not going to be that much as well. In Michigan, Midland, the inventory is picking up by 57% year over year. Its price change is 19%, so that's like a mild increase in price. It's not that like really that crazy. All right, so let's go ahead and go into Zelle website. And see the market movement in this area. Prices are not like super crazy. Most of them are in 100K, 200K tiers, and there are price cuts such as 15K in that one. Okay, this one also has 15K. And for this one, you can see that it's a 10% price cut. So that one is getting hefty as well. So these patterns are a little bit different, but the price cut is also kicking in. All right, so a few more price cut here and there as well. I'm just like randomly clicking in some of these properties to see what's going on. You can see that these houses are not that bad. It's pretty spacious, but just in general, there's not a whole lot of like economic activities here. So I would say in this area it's a little bit underperforming while still feeling the impact of mortgage rate. In Tiffin in Ohio, inventory is picking up by 81%. So that one is also not looking that great. The year-over-year change in price is 13%. In Mount Vernon, it's picking up by 75%. So in these areas, you can clearly see that the inventory are just hitting the market. So now we're going to go over to the southeastern part of the states, and you can see that the greens are getting darker. It means that the year-over-year price change is getting more. Because in general, like since the pandemic, probably even before the pandemic, there are a lot of people that are rushing in from the West Coast, from really expensive areas that are moving into this area. There are a lot of buyers as well as renters. So I would generally say that the inflexible demand in the southeastern corner are very, very strong, and they're just resistant to the Fed funds rate schedule, whether they're increasing or not. They're not reacting right now. In these very hot states, for example, like in Tennessee, in Atlanta, Georgia, and in South Carolina, some of these states, there are also real estate markets that are starting to crash as the inventory starts to pick up. So we're just going to focus on those areas for now. So the first one is McMinnville in Tennessee. You can see that the inventory is picking up by 41%, and then its price increase is at 17%. So that's one. And then in Georgia, there's Summerville. It's also picking up at 42%, and its price is at 16%. So these are very mild price increase, but you can see that the inventory is also picking up. While, the rest of the areas are not really reacting that much. And then in South Carolina, in Greenwood, you can also see, this one is a little bit aggressive at 54%. So the price increase is at 18%. So you can tell that, this area is also going to feel the sort of really bad crash, possibly in the short term. So we're going to go into this area to see what's going on. And some of these areas, the price, compared to, if you're comparing to, South Florida or even some parts of Central Florida, the prices are very, very affordable. So, if you're looking for like new places to move to, because these areas are feeling like price cut, you can definitely look at, some of these areas. It's spacious. It has like very good natural environment. That's what people are looking for these days. And then the inventory is hitting the market. So you might want to focus on these markets rather than the other really like overpriced markets. Well, we see that there are like price cuts. 2,000, 15,000. So there are fairly a few price cuts here and there. This one is also a 10% price cut. So just go through these micro markets, and you're going to see what's going on in the market. And let's also do a calculation here to find out, when is the crash coming. Let's do this one, for example. All right, so it's $2,000 price cut divided by 257K. So that's less than 1% price cut. So you're not going to see like a whole lot of things going on. And then if we do this one, so that's approximately 9% price cut. So that one, because we're looking at 18% year-over-year growth, let's do this, divided by 8%. So it's going to crash down in 2 years or something like that. So I can see that the price cut is not really like super aggressive in this market. And then buyers and sellers are kind of like having a dynamic situation here. They're testing the water to see, you know, how the mortgage rate is moving and then move accordingly. All right, so these two charts are like super helpful to understand what's going on in each of these micro markets. You can definitely click into each one of them, but because of the time constraint, I'm not going to do that today. But I'll publish them on my website as well as my Tableau profile, so definitely go check them out. And use the calculation method that we talked about today, either by subtraction or division, you know, depending on how you want to do it. And then you can figure out, you know, when is the housing crash coming in the market that I'm looking for, and how am I going to plan financially. So what I'm doing today is literally showing the sort of like financial situation or status of the markets to show you what is going on in there. All right. So we're going to cover more of the other housing markets in the next video. So I hope you find it useful in today's video. So stay tuned, and I'll see you on the next one.